Imagine leaving Australia but receiving a capital gains tax bill even though you sold nothing. Australian tax rules can treat residency changes as tax events, creating deemed gains. Residency for tax is different to citizenship, permanent residency or visa status. Your personal circumstances determine whether you are an Australian resident for tax purposes. When you become a foreign resident, Australia generally disregards capital gains on non-taxable Australian property, or non-TAP. Taxable Australian property usually includes Australian land, interests in land-rich entities, and assets tied to an Australian permanent establishment. Ordinary portfolio shares are often non-TAP, but every investment must be assessed individually. That determination affects whether Australian CGT rules continue to apply after departure. So what happens to gains that built up before you left? CGT Event I1 treats non-TAP assets as if sold at market value immediately before you cease Australian residency, a deemed disposal. For example, if you bought shares for $100,000 and they are worth $180,000 when you stop being a resident, Australia treats an $80,000 gain as realised for tax purposes. You still own the shares, but the deemed disposal creates that capital gain under Australian rules. An individual can elect to disregard the deemed gains and losses from CGT Event I1, which defers rather than necessarily eliminates tax. That choice generally applies to all assets covered by the event, not individual assets. There is generally no separate election form. How you prepare and lodge your departure year tax return usually indicates the choice. Including deemed gains shows recognition of Event I1. Excluding them generally indicates choosing deferral. Now reverse the situation. Becoming an Australian resident while already owning investments can create a deemed acquisition. Non-TAP assets are generally treated as acquired at market value when residency begins, bringing post-residency growth into Australia's CGT system. For instance, if overseas shares cost $100,000 originally and are worth $160,000 when you become resident, and later sell for $220,000, Australia would generally use $160,000 as the deemed cost base. That results in a $60,000 Australian capital gain rather than $120,000 based on the original cost, under the rules. Broadly, Australia taxes growth that arises during periods of Australian residency and may disregard non-residency growth for non-TAP assets. Temporary residence, main residence exemptions, and Australian property rules can change the picture and must be considered under the law. A practical point many miss is that you need to identify your exact tax residency date and support valuations before preparing the departure or entry year return. How you lodge that return affects how assets are treated in future Australian taxation. This explanation is general information only and not tax or financial advice, referencing Australian CGT concepts and ATO guidance. For specific circumstances, the legislation and official ATO material should be consulted.